Welcome back, everybody. This is WealthWise on Biz Talk Today TV, and I'm Jeff Hirsch, your host. Thanks for tuning in. I'll be joining you here every week on Fridays after the New York close. I'll run through some recent market action, what's on my radar, then I'll dive into my featured guest. This week, my good friend Sam Stovall joins me. I was planning on reminiscing with Sam about the old days, our late great dads, both Wall Street legends, and talking about Sam's process and history, but this Trump tariff market route deepened today, pushing NASDAQ into bear territory. So I'm pleased to have Sam here to share his insights. But let's first briefly assess the damage a little bit. I'm going to pull up a couple of charts just because there's not a whole lot that's so relevant today, this week, other than the tariffs. As I discussed last Friday, there's really no way to sugarcoat this. The market's telling us there's trouble ahead. It looks like it's kind of regime change to bear market. We had a down Q1. Here you can see in this chart, we're tracking these bearish post-election year patterns, the first year for presidency. I've taken some of the other lines on and just kept the incumbent party's loss line. Here, I'll put on my pointer so we can highlight that a little bit. The black line, years after incumbent parties lose, like we had this year. Republican administrations since 1950 in the blue, and then the 53 to 81 years that I think we may be looking similar to. Sam and I'll discuss some of that. This is right out of page 28 of the Stock Traders Almanac. So this week's nosedive is not likely the end. Further downside is expected. We're advising people to sit tight, wait for the fatter pitch, generate some cash when possible. Don't go selling into this negative down day, but do what you got to do to preserve capital. Excuse me. Little else matters right now other than the tariffs. Retaliation is happening. Trump's appeared to have dug his heels in already. Basically, the tariffs that were announced on Wednesday were worse than the worst case. They were not limited nor focused. They were broad, affecting 180 countries. It's causing confusion and uncertainty, exacerbating the trade war, stagflation, and recession fears, and the odds of a bear market. Support has been broken. Basically, until some resolution is achieved, we'll likely trend lower. So buckle up and wait for the fatter pitch. I'm going to show you a little comparison to some of the years in the 70s. I've got a 2-year look. We had an election in last year, 24, that was similar to 68, with the sitting Democrat dropping out and some issues going on. The green line is the 68 through 1970, which was a May bottom. Actually, my fourth birthday, 1970, May 26th. Don't remember it, but I remember Watergate. And then this 72 through 74, I've added the 3 years here. I'm feeling a little 73. Sam and I'll discuss. It's kind of an analog here. We're down into this period. There was, we had come off the gold standard in 71, 73 period. It started to take effect there. There was also the Arab oil embargo. I've had some queries from subscribers and others about putting up the 1930s, 3031 on this when the Smoot-Hawley Tariff Act came out. I'll be working that into my charts in the near future. And then just a little technical, it's hard to get too technical here. I mean, there's really no support. It's pretty self-inflicted and emotional. You can see here we're down on the S&P today. I put a box around this old potential for the W123 swing bottom that didn't happen. We broke that. We broke the support here, the September lows. I had drawn this trend line from the April low through the August low. We came through that. We came through 5,500. We basically gave back all the gains for 2024. And it's just, it is what it is. And you have to be patient and be calm. I guess I've been hearing some things about retail buying these days. I can't comprehend that so much, but when that stops, when that dries up and people start selling, I think we'll find a low there. So with that, I'm going to take down my charts. bring in my friend, and we're gonna have a little chat about what's going on here. How are you there, Sam? Pretty good resume. It's grown. He's the chief market strategist at CFRA, and I looked that up, and that stands for Center for Financial Research and Analysis. I'm always interested to know what these abbreviations stand for. You're the analyst, publisher, communicator of CFRA's outlooks on the economy, market, and sectors, author of the Seven Rules of Wall Street and the S&P Guide to Sector Investing. Your weekly Sector Watch and investment policy reports that come out on the platform, I read them religiously. I know you also maintain the two portfolios, industry momentum and sector rotational portfolios. Your work appears in the firm's newsletter, The Outlook. You were the managing director and chief investment strategist at S&P Global for 27 plus years. Before that, editor-in-chief at Argus. You got your MBA at NYU. Your old alma mater, Muhlenberg's, where you got your BA in history. You're now a trustee there, I understand, right?
That's right.
And the board of WISE, promoting financial literacy, which is pretty cool. Before we get into this craziness, let's talk about what you're doing outside of the market. I mean, the financial literacy is I know you've done a lot at NYU. What's going on there these days? I know today is kind of crazy. We'll get into that, but it's important that people are prepared for days like today.
Well, first off, you left out something in the resume, and that is great admirer of your dad and your work. So I've been a very big student of the Stock Traders Almanac, and try to put my own spin on things or come up with my own type of historical lookbacks. But I think you guys should take a lot of credit. But what I do with financial literacy is WISE is working in support of education. It started out in New York City. Phyllis Frankfurt started it. She used to be on the Board of Education in New York. And it has grown. It's now in every state in the US. We have exposure overseas, et cetera. And the purpose is to speak to high school kids about personal financial planning, if you will.
Just the market too, or just personal finance?
Mainly personal finance, but yes, they are getting involved in understanding the market. I was talking to John Schoenberg up at Cardinal Spellman High School last week, and he gets his students to research ETFs just to understand what they are, why would you want this one over that one, et cetera. So he does a great job with his students. They then take the WISE exam, and if they score over 90%, then they get invited down to the New York Stock Exchange, see the ringing of the bell, and have people come in and talk to them about investing. So it really is a good encouraging factor for these students.
Yeah, it's something that I think is lacking. I have two sons. One's in college now. He's big into the market. He texted me about buying Nvidia the other day. I'm like, not yet. We have our chats, and the younger one is graduating this year, going to Northeastern. Thank you. We're very proud of him for that. But you don't see them being able to balance a checkbook, keep track of money and the market. So we work on that a bit. I got to say something about your dad. I bring it up from time to time, but the quote that I have in the Almanac of his, I mean, he was cool. We were on a Father's Day show a bunch of years ago, the four of us, which was a treat. But your dad had such a knack for words. I mean, both of our fathers could turn a phrase, but it was his line that I love is, selling a soybean contract short is worth 2 years at the Harvard Business School.
Well, he always would say to me, but there was one phrase left out: selling a soybean contract short in a rising market.
Oh, yeah, I think that was a Yale edit.
But basically, yeah.
Unpack that for me a little bit.
Where I was going to say, when your son asked you about, gee, should I buy Nvidia? You probably said, well, go ahead, see what happens. Because the best way to learn is to lose some money. And then you say, oh my gosh, what are
everybody's learning today, right?
Yes, exactly.
Yeah, you got to have your own skin in the game. So, so your history, I went through your resume, but how did you get to this position of being the voice of reason and history of the markets?
Well, I think it's because I am like most average investors out there today. I can, if left to my own devices, my emotions could be my portfolio's worst enemy.
Oh,
So, the
mine as well.
best bit of investment advice I ever got came from Clint Eastwood when he was playing Dirty Harry in the movie Magnum Force. He kept mumbling through grit teeth, "A man's got to know his limitations." So I was thinking, well, what are mine? And my ego will only allow me to admit to three. I have so much data at my disposal, I can be frozen by indecision. As a
Mhm.
result, they say my favorite color should be plaid. But I'm also impatient. If I buy something, I want it to go up right away. If I sell it, I want it to go down. But the quote that you have in the Stock Traders Almanac, which I'm very happy you do, is in this day and age of instant information, I can experience both fear and greed at the exact same
Like same
moment.
time. Yeah.
And so
Sure.
as a result, you can end up being your own worst enemy, especially during market declines. So in early March, I was down at the Wharton School at the Securities Industry Institute, where I now teach two classes, and
Right.
it's the same class twice, but it's called Using Stock Market History as Virtual Valium, or how by understanding what happens in the market, history can prepare you for
I mean,
volatility.
even most recently in 2020 and 2022, it hasn't been that long ago since we had some market downdrafts. It's only been 2 years. People forget that, this too shall pass. Yeah, it hurts now, but at least within a couple of years, we're going to be at new highs. I mean, you can't say going to be, but quite likely based on history.
Sure, absolutely. And when people say to me, Sam, investing is just gambling. And I say, oh, really? Well, if that's the case, I would love to know which casino pays the gambler 80% of the time, because total returns have been positive 80% of the years since World War II.
So, what's the process for you and your philosophy of how you put information together and guide the investment policy committee, or at least put everything together for your clients and the advisors that you talk to, and that, you talk to everybody out there in the world. So what's the process?
Well, I think the process, first off, is where are we? Where might we go based on what history suggests? I mean, back in 2023, in the beginning of the year, everyone was saying, oh my gosh, we were down 19.5% in 2022. It's going to keep going in 2023. And I'm always reminded of the old phrase that investors tend to forecast recency. And
Yeah.
so, is that really the case? And historically, the market does better the year after a market decline than it does after a market advance. And then looking at the January barometer, what I found was that if you have a down year followed by a positive January barometer, the market is up more than 20%, rising 92% of the time. And if you add to that a Q1 low that did not undercut the prior December low, the market was up 100% of the time and rising about 25%, which bing was what we got in 2023.
Not
Um,
happening this year.
and in the year following, so what happened this year?
It's not happening this year. We broke through that Q1 low, didn't we?
That's right.
I mean, the
And,
December low in Q1. Yeah.
yeah, and actually, a lot of the indicators from the almanac, because they were in disagreement with one another,
Hmm.
indicated to me that the investors don't know what they're going to do this year. We had a negative Santa Claus rally, we had a positive first 5 days, positive January, but then a negative Q1 low. I mean, we
The
undercut.
December low indicator.
Yeah.
Yeah. Yeah. Yeah.
So anyway, those things I think, told me that this is going to be a challenging year. And there were a lot of other things that I had implied to you when we were doing sort of a
Yeah.
pre-interview
Yeah.
to say why I think that this year is doing exactly what I had expected it to do.
Yeah, I mean, history's your thing, mine as well. We talk about history together a lot. So what were some of the warnings that you saw that we
Well,
should be prepared for this?
well, heading into the year, everybody was so excited about the Fed cutting interest rates and so forth. And I kept thinking, there's an old phrase that wanting is more rewarding than having. Because if you look at the Fed funds rate going back to when Alan Greenspan started the transparency effort of announcing when Fed funds changes occurred, the market was up 19% on average in that 12-month period between the last rate hike and the first rate cut. Yet, on average, including the current move, the market's been up less than 2% in the subsequent 12-month period, with 3 of those 6 periods, 3 of the 7 periods being negative. So I think once the Fed does start to cut rates, it's usually because it needs to. Second, we're in the 3rd year of this bull market. We've had 11 bull markets that celebrated their 2nd birthday. Of those 11, 12 months later, we're actually up only 2.2%. Take away the 3 that actually fell into new bear markets and therefore did not celebrate their 3rd birthday.
The 3 Pete's, as you told me, right?
Well, hold on, that's
no.
Whole thing. So the 3rd year of the bull market, even take out those 3 that became bear markets, the market was still up only 5.2%.
Right.
Because we had 2 more times in which the market posted declines, not enough to be new bear markets.
Right.
And we had 3 times in which we had like a gain of 6.5% or less. So year 3 is for the market what the terrible 2s are for child rearing. If you get through that period, things look okay. Also, you would just mention 3 Pete's. Going back to World War II, you have a down year followed by 2 double-digit gains. What's the likelihood of a 3rd double-digit gain? 20%, so 1 in 5, and the average change is a gain of only 5%. So, I'm looking at really the probabilities, and as the Kansas City Chiefs know, scoring a 3-peat can be a pretty challenging thing to do. Also, what's pretty interesting is that in year 1 of the presidential cycle, about 90% of the time, we have had a decline of 5% or more during that year, and the average decline has been 17.5%. Through today, the market is down 17.4%. So
that's the average drawdown? Is that the drawdown or the full year gain? The full year return?
No, that would be a drawdown, meaning if we fall into a pullback or a correction or a new bear market, what is the decline that we experience?
So wait. This is a good stat for me. I'm a post-election year. I'm a 4-year sub guy. So you're saying that the average drawdown, and this is going back to what, 1930 on the S&P or 29 or
going down to 1945.
45. So the average drawdown in year 1 of a presidential cycle is 17.5%.
Yes.
That's a good stat, man.
We might differ because I know you crunch your own numbers very well.
That might be S&P total return.
Well, it could be total S&P, but I also included if we started a pretty hefty bear market, then I included what the total decline was. So maybe what I could redo so we could come up with the same numbers would be looking exclusively at that calendar year.
Yeah.
What was the drawdown? So
either way,
it basically
we both know from what Yale taught us in the Almanac for years that post-election years can be trouble. The recent, since '85 have been quite strong. And we have a page in the Almanac, this year's Almanac, that, one of Yale's creations, that the performance by party is post-election years are more difficult for Republicans. They tend to come in and, sort of kick ass, take names, and get things done quickly. We're seeing it like never before. Or at least as far as I can remember. So, we've got that presenting itself here. Post-election years and midterm years, first 2 years of the term, where we see more recessions, bear markets, and war starting. Like we had the Ukraine war starting in 22. So it's definitely a troubling year. And looking at where we are right now, and you saw the chart I put up there, we've broken through many of those trends, and a lot of the comparisons continue to trouble me. I'm starting to get concerned about the 70s, even some of the previous periods people are throwing out 08, 09, and the 30s. But
I'm getting questions now from the media saying, okay, what is the typical PE ratio at the beginning of bear markets or beginning of market declines that precede recessions? And how far are we away? Meaning, what's the implication of our downward move based on what our PE ratio was on February 19th? So I look at that two ways. One way is, oh my gosh, if we're already thinking about the world is coming to an end, and let me find out how it'll happen, by falling into recession, what kind of a drawdown are we expected to see? That sort of goes along with the CNN Fear Greed Index, which is now at almost lower than whale dung, and also looking at other emotional indicators. The thought is, gee, maybe
we gotta dial up some of your humor, buddy. This is too rough a day to not highlight some of your. He's always got a joke for me whenever we meet at any event. It's always a new joke. But anyway, lower than whale dung. Go on.
So, from a contrary indicator perspective, if people are already asking me how deep could this recession be and bear market, so I went back to World War II, looked at GAAP earnings because we only had as reported earnings up until 1988. So to make sure that I'm comparing apples to apples, not apples to oranges or even oranges to tangerines, the average, or I should say the median PE ratio at the start of declines ahead of recessions was 15.6. The PE on trailing 12-month GAAP earnings just before this market decline
much higher, right?
I'm sorry, was 26.6.
Yeah.
Yeah. So that would imply a 41% premium. And so this could, I guess what people are basically wondering is, if we do end up in a new recession environment, could this be a mega meltdown bear market or a decline of 40% or more? And as you were talking about before regarding the oil embargo of 73, 75, that's certainly a possibility.
Yeah. You mentioned sentiment. What sentiment measures do you look at? I like Investors Intelligence. I brought up recently that the bulls just kind of got less on the bears. We dipped into that more bears than bulls area for the first time, and then we bounced back up. People got bullish again. A little bit early, because I've seen the first foray into more bears than bulls is usually not the end before the bottom of the market. Which ones do you look at?
Probably a little simpler ones. I look at the Fear Greed Index. I look at the AAII, and I look at the market itself. What percent of the stocks are trading above their 50-day, 200-day moving average? What percent of the sub-industries in the S&P 1500, and there are 155 of them, what percent are trading above both their 50 and 200-day moving averages? And as of last night, it was 22%, which is still, it has a ways to go before dropping to the 5% level, which historically has been a washout zone.
Below the 50?
So there are 155 sub-industries in the 1500, and what percent are below both their 50 and 200-day moving averages? And right now it was at 22% last night. And so since S&P takes its time to compute the sub-industries, I'm sure that it has fallen, but it's probably still well above the 5% level that historically has pointed to a total washout.
We're not there yet. Another case for us not being there yet. So, but you are an optimist by nature. What is your when life gives you lemons, you make whiskey sours, right?
Exactly. And
so what's on the bright side of this action here?
Well, two things here. First off, I like to say to investors, especially my friends who are nervous Nellies, by the time you work yourself up into a frenzy over a market decline, by the time you have called your advisor so many times that they say, okay, I'll lighten up your equity exposure just so long as you stop calling, by then the market is probably already on its way back to break even. There have been 63 pullbacks or declines of 5 to 10% by my calculations, taken only 1 month to go from peak to trough and about a month and a half to get back to break even. The amazing thing about corrections, and we have had 24 of them since World War II, And I look at a round trip as being one. Like you can't have multiple pullbacks within a correction. It's either a correction or a pullback. Anyway,
What's the correction level? 10%?
10% up to 19.9. And on average, it's taken only 4 months to get back to break even. So the speed with which the market gets back to break even the speed in which the market goes from a bear market low to a new bull market 20 plus% advance has been an average of only about 3 or 4 months. So amazingly swift.
There's some work that we do on that Yale started years ago. We called it waterfall declines. How the market comes back after these water. I mean, this is clearly a waterfall decline. So
Yeah,
we'll be rolling out that.
And one more thing is, okay, well, once we do get to a bottom, which is always the hard thing to measure, to pinpoint, but what typically happens, how should you rotate when the market has finally exhausted the downward move? And the answer is you want to rotate from first to worst, or as in New York, we say from foist to hoist. So basically what it says is instead of sticking with the ones that held up the best, consumer staples, healthcare, utilities, you rotate out of them and into the worst sectors, 3 sectors, and the worst 10 sub industries. And going back in time, whenever we've had declines of 10% or more, in the following 6 months, the market was up 22%, but the three prior best sectors, meaning consumer staples, healthcare, et cetera, up only 14%, beating the market just 8% of the time. Whereas the 3 worst sectors were up 27% and beat the market 83% of the time. And the 10 worst sub-industries were up 34%, beating the market 2 out of every 3 times. So
how do we know when the time is right to get into those dogs?
That's the hard part. I guess unless they read your newsletter and look at MACDs and so forth. But that usually is a pretty challenging thing. Yes, I do like to look at those indicators that I have, in terms of percent of sub-industries below their 250-day moving averages, and then just looking for other series of variety of indicators to say whether we are at a bottom.
I guess that sectors above the 50 and 200, when it comes back up to maybe a decent percentage from being only 5% at the washout, when it starts to come back up from there, that'd probably be a decent way to gauge a turn.
Absolutely. Yep. Absolutely.
So, what's with this tariff policy thing? Do you have any read on that? Everyone's talking about the 1930s. Is there any rationale here? Is there any positive, or is this just as what Jeremy Siegel called it, the worst policy in 95 years or something today? Right.
Right. Well, he's got a plan. The president has a plan. It might not work out. It certainly is not working out so far. And because the plan is not really being communicated, I guess you can't really tell your adversaries, well, I'm going to go here and then go here and then go here. But we have to keep saying to ourselves, well, the president tells us he likes to be a negotiator. He likes to, focus on the art of the deal, et cetera. So he's not going to stick his heels in the ground and not budge at all. To me, right now, it's like the opening salvo between management and the union in some sort of a negotiation where they're so poles apart that it looks like, oh my gosh, something is never going to get done. And then as time goes on, they move closer to the center and something does get done. So, the feeling is the 10% tariff is likely to be the base for everybody. And our Washington Analysis Political Strategy Group thinks that essentially the countries are going to start to, give way, and then the president will then give way in response, and then work the way back down to about 10% after these countries have taken down many of their elevated tariffs. But the problem is that this is a manufactured correction. You and I were chatting about what this sort of remind me of. sort of reminds me of the dispute between President Kennedy and U.S. Steel back in
Yep.
1961, where Kennedy was thrilled because the inflation rate was coming down, and then U.S. Steel wanted to raise the prices on steel, and he says, "No, you can't do that." And so he was trying, his administration was trying to put a lid on steel prices, and that ended up with a 28% bear market that was not associated with a recession, but it was clearly a manufactured correction that morphed into a bear market.
Is this some sort of attempt at doing something to interest rates, whether it's lowering what we pay on our debt or forcing the Fed's hand, or is that something that you wouldn't even
Well, I
play at?
mean, it's certainly, he has said he wants interest rates to come down. Didn't really tell us specifically which set of interest rates. The Fed obviously controls the short end of the curve, and the market controls the long end. And the long end is coming down because of the rising risk of recession. I don't think that's a really good way of getting interest rates to come down.
No.
Because and then once we do find that maybe the tariffs are beginning to be relaxed or whatever, then the 10-year yield is probably going to work its way back up again, as we await to see what kind of impact there will be on
Just
inflationary measures. And in a sense, today, I think some people were probably hoping that the employment data would be weaker than expected, because then the Fed would be more likely to step in quicker.
right.
But that's just not the case.
A little bit of a flight to safety into bonds, getting the rates to come down as well. Another thing, I think somebody I'm going to have on the show, Helene Meisner. I don't know if you know Helene, the chartist. She threw out the people forgetting about the Bush steel tariffs in 2002, which created a major. Not that that was the whole impact of it, but 2002 ended up having a pretty solid bear market bottom there at in the fall in October there. So I don't know if there's anything there, but another.
That sort of sounds like piling on. After the market had already gone through a 49% bear market because of the tech bubble bursting,
Yep.
add to that 9/11, and then with the steel tariffs, it's like, okay, it's almost like bad news comes in threes, and that was the third thing.
Like in the 70s with the oil embargo and the gold coming off the gold standard. So speaking of gold, gold hit an all-time high and now it's come off. Any sense of what's going on there? Do you have a read on gold?
Well, it's, I mean, we have a strong buy recommendation on Newmont Corporation. I probably should have asked you before if it's okay to mention names, but
Sure, whatever.
anyway, so we do have one there. And the feeling is because of the uncertainty. I mean, gold is a bit of a balance for a portfolio because of the flight to safety qualities. Also because of the desire for that precious metal by central banks, by consumers for jewelry, et cetera. It does not pay a dividend. It costs money to store. So, you're really not going to be getting something other than a softer pillow to sleep on, if you will, from a metaphor perspective. That's why I don't necessarily think that that cryptocurrency is regarded as a safe haven, because
No,
you can't wear it, you can't eat it, and
hard to cash it out too.
yeah, very much so.
I mean, I did some seasonal work on Bitcoin, and it really seems to just be a stock market tracker, a Nasdaq tracker with about a 4x move,
Yeah.
because it's just a speculation. So I don't know. I'm telling people, they say, well, where should we put our money? You don't have to trade. You can
Right.
cash and bonds. I mean, is that the only place to hide right now? The only place to sit tight I mean, you said you got a recommendation on some of the miners, but
Yeah.
cash bonds a
Well,
place to be.
what's interesting though is that there really is no place to hide. We know that from certainly a broad benchmark perspective. The S&P has declined an average of about 28% in declines associated with recessions. Small caps have declined something like 37%. So from that perspective, and international stocks down about 35%. during recessions here in the U.S. On a sector basis, yeah,
Small caps still haven't cleared their 21 high.
Exactly. Yeah. Small caps tend to be among the worst performers because in a recession, you're going to have banks be more careful about to whom they lend. A lot of these smaller companies are more retail oriented. And so with the consumers, focusing only on the needs, not on the wants, small caps tend to have their problems. Of course, they do fairly well coming out of recession, but certainly not going into recession. Looking at the sub industries in the S&P 500 going back to 1990, which is as far back as S&P has data, not surprisingly, the old adage that when the going gets tough, the tough go eating, smoking, and drinking holds true, because tobacco, brewers, and packaged foods were the best performing groups, even though they too were in negative territory on average.
Yeah, so kind of not really anywhere to hide. What else is on your radar right now? What other observations that you could share with us? What do you
Well,
think people should be looking at?
again, sort of coming back to the that virtual Valium stuff that I talk about, is what's happening now is pretty natural. I do talk about the speed of getting back to break even. I also talk about, like, a lot of people ask me, well, gee, Sam, what about the fact that we went down below the 10% threshold so quickly? And I say, well, actually, that's sort of a good sign.
Yeah.
That normally it takes about 82 days for the calendar days for the S&P to go from its recent high down to the 10% decline threshold. This time it occurred in only 22 calendar days. So if you break up all of those 40 declines of 10% or more, those that either stayed as corrections or became bear markets, break them up into quartiles, the quickest quartile to hit the 10% decline threshold ended up falling the most shallow of the four quartiles, did so the most quickly of the four quartiles, and got back to break even most rapidly than the other three of those four quartiles. So no guarantee.
Where is this one in the quartiles?
It's in the lowest. So it's ranked number 9 of 40 declines of 10% or more since World War II. So it's in the most rapid quartile, and the most rapid quartile tend to fall the least, get there the quickest, and then recover the fastest.
An encouraging thing, encouraging fact and stat. Kind of like 2020 and 1998, some of those shortest bear markets on record type of situations. So, really kind of leaving it, in that positive note here. We'll wind down a little bit here. What's coming up for you? What can people find you? What's on your agenda? You're going to be speaking, appearing?
Well, just mainly appearing because CFRA is now 100% remote. So I was on Bloomberg Radio a little while ago, and Tom Keene said, "So Sam, are you talking to us from your villa at the Hamptons overlooking the Atlantic Ocean?" And I said, "Sorry to disappoint you, Tom. I'm talking to you above the room above the garage in Allentown, PA." And so that's where I live. That's where I work. And most of my work that I do now is remote on Zoom. I do go to the money shows. Been to the one in Sarasota the last 2 years, hopefully to get invited to some future ones. But most of my work is through CFRA clients or as a talking head on CNBC, Fox, etc.
So give us a little guidance, a little advice for traders and investors as we head into this weekend after a pretty nasty week. What should people do? Old versus young? I mean,
Yeah. Well, first off, I think you have to look inwardly and say, what kind of a person am I? I'm not a trader. I'm more of a longer term investor. And as you said at the top of the show, is that very good likelihood that, we're getting to a point where we have some pretty nice buying opportunities ahead of us. You can't rule out the fact that we are headed for recession if, the longer that these tariffs remain in place, the deeper this market is likely to fall. and the longer that it'll take to do so. But beyond that, stocks tend to pop after a drop. Going back to World War II, there have been more than 900 days in which the S&P rose or fell by 2% or more in a single day. And of those 900 plus times, 48% were up, 52% were down. So, I mean, it's almost equal in terms of the kind of volatility, but it's natural. 44% of all trading days of bear markets are 1% moves, yet only 15% of trading days during bull markets are 1% moves. So hence the old adage that the bull market takes the stairs, the bear market takes the elevator.
That's right.
So I would tend to say, focus more on the longer term, take advantage of those sectors, those sub-industries that get beaten up the most because they offer the greatest upside potential. So, I would basically say, understand yourself. If you are a longer term investor, then look to pick up some very attractively valued stocks, sub-industries, and sectors. If you're a trader, then look for a technique that works for you, and make sure that you put your emotions on the sideline.
That's what I've been saying. Check your emotions at the door. So where can folks follow you, find out more? What's the best place? LinkedIn?
Best place is to go. Well, I'm in LinkedIn, also at Stovall CFRA, but just go to CFRAresearch.com because you can get free trials to our wealth advisory research called Market Scope Advisor. And also we have a technical analysis arm called Lowry Research, and you can get a 30-day trial for Lowry Research free of charge. Just go to CFRAresearch.com.
Excellent. Well, thank you, my friend. Have a relaxing weekend. I want to thank everyone else for joining me. Again, I'm Jeffrey Hirsch for WealthWise on Biz Talk Today TV, available wherever you stream your podcasts, also on YouTube. For more information on the Stock Traders Almanac on my newsletter, go to stocktradersalmanac.com. Check me out on social at Almanac Trader, or just Google me and the Almanac. And I'll see everybody next week. Happy Friday.